forecasters monitoring Tropical Storm Philippe amid what has been a record year for weather and climate disasters in the U.S. The increased risk of natural disasters sending insurance companies fleeing from states like California and Florida. Meanwhile, nearly 39 million properties have risk of increasing insurance prices or reduced coverage. This, according to a recent report by First Street Foundation. To detail the financial implications of climate change for Americans, Jeremy Porter is joining us. He's First Street Foundation Head of Climate Inspections. Thank you so much for being here. This is really interesting stuff, and the stakes are high for many, not just Americans, but citizens around the globe. But talking about insurance specifically, we have seen insurers pull out of some states. How widespread, Jeremy, do you think that is going to end up being? How difficult going forward is it going to be for Americans to get their properties insured?
Yeah, that's a really good point. I mean, the real question and the issue that we're dealing with at this point is the fact that we've accumulated this climate debt over the past few decades from increased disasters, increased exposure, increased inflation in recent years, increased cost of reinsurance. All of these things have compounded with the decisions on where we've made to develop in the past. And at the intersection of that is increased payouts that are having to be made by the insurance companies. And so insurance companies are simply responding to the fact that it's just not sustainable from an actuarial standpoint to continue to price premiums at the levels that they've been for decades. They've been increasing, but we've seen this huge spike recently. And when you roll on top of that regulatory policies that exist in some of the states, you end up with a situation where insurance companies just can't do business in a way that makes sense for them. So they're pulling out of those out of those markets.
And we have insurance largely regulated at the state level. So we have 50 different competing policies here. And then we have the various state governments with increasing or decreasing levels of, activity in the insurance market. Let's take Florida, for example, where you have them as the last insurer of wind damage, for instance. How are the state actors involved in this? And what do you think is their culpability? What needs to happen at the state level, if anything, to just raise the level of insurance back to its traditional level, or to its traditional role, which is you take a large group of people, a cohort, you charge them a small amount of money, and then when a damage strikes one part of them, they get a payout, but it's financed by everybody. It just seems we've gotten away from that model a bit.
Yeah, the insurer of last resort approach that we're talking about here, like the Citizens program in Florida, is really problematic in the sense that it's taking on the highest risk across the state. So it's not distributing that risk across a portfolio in which it can sustain the impact of some of these disasters. Instead, what's happening is it's taking on high risk properties across the state. And Florida is pretty unique in the sense that the insurer of last resort, which is really intended to be a residual insurance product, only reserved for the highest at-risk properties, has become the largest insurer in the state. In no other state is the insurer of last resort the largest insurer of the state. So it's both the largest insurer and it takes on the highest risk properties in the state, and that's just not sustainable. And all it would take was one natural disaster to hit in one specific location, and the program wouldn't be able to cover all the claims that would come in from the damages.